to get together focus groups and determine, do you like this? Do you like the Snickers with peanuts or less peanuts? Today, it's crowdsourcing, and you can almost instantaneously, get information out there and get feedback, and that's so important.
Big turnoff on a deal for me, and it may be unique, but I don't like teams that don't have tech as part of their DNA. I see too much of that in LA. Oh, I got 3 buddies. We got together. We found a firm to build the software for us. As soon as we raise funding, we're going to build a tech team. Non-starter.
It's a good question. I guess in order to give an answer, since we have to give an answer, it's entrepreneurs who don't engage in a conversation with you in the meeting, but they're either lecturing you or certainly not listening. And I don't expect people to, the purpose of the meeting is not for me to preach to them or tell them what to do, but people who don't engage in a conversation, who you can tell aren't listening, don't get a second meeting.
See, I think my biggest turnoff is probably founders I just don't like, and no, it's true. I mean, it's a long relationship when you commit to be an investor. It's not just money. It's years of work with a founder, and the reason I don't like you is not because you smell or you have bad taste in art or whatever. I may not like your vision. I may not think you're very intelligent. I may not think you're thoughtful. I may not think there's so many things, but I think it's an important decision for something to communicate to other angel investors is to realize that when you throw that check over the rail, this is someone you have to work with. You can't divorce yourself from that responsibility. So I really look at people that if I got a call at 2 in the morning, I would take that call and want to help them. So, and back to Mark's point about the people are very important. I wouldn't say that the people are the only thing. I do like brilliant ideas, but I have to like you. If there's some chemistry, if I don't want to sit down, have drinks with you, and do business with you, I'm not going to sign up for 3 to 8 years of helping you out.
It's been said. Let me say a couple of things about what I like. I like entrepreneurs with an incredible amount of optimism. I like people who are willing to take or listen to others' ideas, that are capable of running that course of, we might have started out with X and it's going to turn into Y, and I have that flexibility. People who surround themselves with people who are smarter than them and are open to those ideas. Those are all big tell signs for us.
So what drives you away?
Yeah, I think it's all been said. Arrogance, someone that it's all been said.
Great. Okay, thank you so much. So we're going to open up for Q&A. Mark?
Mark Landay, Dynamic Synergy Executive Recruitment. 2-part question. First part, current purported valuation, buy or sell, Twitter, Facebook. Second part, what valuation multiple do you look at from investing on hope and promise versus traction?
Honestly, I had this question at Open Angel the other day. I have no idea what valuation I invested in these people. Style see that and some other deals. Sometimes I write checks. As an angel investor, it's not a big deal to me, but I think typically I'm seeing 1.25 to 2.5. It all depends, but it's just not a big deal for me on valuation. So I'll let the investors talk about it.
I think the value range that Paige has laid out probably is the standard distribution curve of values for people raising $250,000 to $1 million, $250,000 to $1 million. I can't remember you had a question about buy or sell Facebook and Twitter. I have no idea.
So you can buy stock. Well, Twitter does not actively encourage second market and private trading, but the rumor mill is that it's selling at $2 billion, and at $2 billion, I'm actually long. Facebook's private valuation is trading at $30 billion, and at $30 billion, I'm not saying anything negative about Facebook, but I'm not long. I'm probably short at $30 billion. We had a discussion about it this morning. One of the more thoughtful guys who was at the table said he thinks that the conventional wisdom says they're going to IPO next year, and conventional wisdom says that, and I tend to agree with that. This particular individual thinks they'll go out at 60 billion. I think that's on the high side. And to your question about valuation, I always answer the same way: is investors, except for angels who might be acting on their own, but angels acting in a coordinated way, or venture capitalists doing a seed A, B, C round, always want to own the same amount of your company. The fairway of what they want to own is between 25 to 33% of the company. It can skew up. They want to own more, either because they perceive they have more market power, or because two investors want to split the deal and they each want to own 20%, so you raise a little bit more. Or if you are hot as a company and multiple people want to do it, you can skew down in the 17.5 to 20%, but it's not the norm. The norm is the fairway is 25 to 33%. So people always say, why would anyone raise $1 million then when you can raise 4 and only dilute 25%? Because not everyone's offering you $4 million. And so it's a balancing act. I usually tell people to raise as much as you can within reason. So don't take $10 million as an early stage company unless you're a second or third time entrepreneur building something that requires that money. But if someone's offering you 1 and someone else is offering you 1.5, for me, I would skew to the slightly higher side, because things generally take longer, markets change, funding environments can get worse than they are, and I always tell people when the hors d'oeuvre tray is passed, if you have the opportunity, take 2. You just don't know what the future holds. But my second comment usually on that is, that doesn't mean eat 2.
Yes, to Mark's point, always treat, any money that you get, that's a golden opportunity. We see a lot of companies in B, C rounds that are struggling to get money, and a lot of them are having to turn to debt at unfavorable rates because they can't get the equity, or they maybe can't even get the debt. To your question, I'll bite. This is a contentious issue. I would say typically we're doing early stage deals. Typically, we don't want to see anything richer than, say, a $4 million pre-money. And I'll give a hard number, and let me tell you why. We've learned some hard lessons in the last few years. What happens to the deal after we see it? Friends and family come in, angels come in, then it goes to Series A and B, and too many times the VCs have told us, look, you overpaid. So imagine that you bought a house 2 years ago at the top of the market, and you spent $700,000 million for it, and now it's only worth $700,000. You overpaid. So that's the scenario that we're faced with, and no one wants to see that.
But Stu, that's just our standard negotiating position with you. Whatever your price, you overpaid, mate.
Exactly.
Well, I guess one of the point from my question was also about traction. How do you, when you look at a deal, how important is it to see revenue?
Increasingly, we're seeing more deals in revenue. And one of the reasons we have such a diverse group, 260 plus members. Some want to see deals in revenue, some want to see early seed stage. It just depends. But if you look again at the life cycle of these deals, 10 years to an exit, green dot, 110x, great return, but it took 10 years. That's a long time. So the thought is that if they're in revenue, they're a little further along, you're going to see that exit sooner, and there's some opportunity there.
I would say there are some investors who have rules about revenue, but most of the time if someone's telling you they want to see a little bit more traction before they invest, it's just an easy way of telling you no.
Probably in half of my deals, I'm the first investor or tied for first, and in none of those deals do you see revenue. So I'm actually comfortable pre-revenue.
Yeah, it's cool with me. Back to Mark's point, sometimes I'll tell people I want to see some more traction. It's not so much that I need to see traction, but I do like to screw with entrepreneurs a little bit and not because I'm malicious, but it's a really hard business, and I like to push people a bit. I recently invested in a company. I pushed them around a little bit to see how tough they were, and they pushed back. Not in a hard way, but I want to see some scrappiness. It's too easy to reach out to investors these days, so I like to make sure that people have the backbone and the soul to actually make it happen.
Okay, what's the next question? Can you come up?
I have a question as futurist. How do you see social media evolving into a browser-like company? Okay, is that better? All right. As futurists, how do you see yourselves investing, or are you currently investing in companies that are becoming browsers like Google did or Facebook? And where do you see that evolving? I mean, what's going to become the next event? Is there ever going to be a place where it's not a browser, but you just log on to the internet? And, you know, like, I guess, where do you see that going? And are you currently working on anything like that?
I'm hot for AR, and anything that's embedded in your head, I'm cool with that shit someday.
I'm not sure I understood the question, so I'm going to pass it to.
I'll make my own definition to the question. I think I understand what you're asking. I would say to you it's already happening, and it's a bad thing, not a good thing. And what's already happening is if you divide using the internet into two halves, and let's call it the consumption half and the processing half. And let me call the front one the World Wide Web and the back one the Internet. And let's define the Internet as plumbing standards. So that includes HTTP, it includes HTML, it includes things that are increasingly becoming things like cloud storage, so Amazon Web Services, S3, EC2, it includes management layer above that. So all that kind of back-end stuff. How do you transfer files? How do you do all that stuff? And the front end, HTML, which has been the standard, the World Wide Web since 1995. Wired Magazine wrote an article, it's worth your reading if you haven't read it, called Is the Web Dead? And the premise is, number one, the rise of mobile has not been the rise of a browser. And your question is about browsers. And what's emerging in mobile, and Alan's already talked to it, mobile has to be integrated with everything you do because that's what consumers are doing. I mean, I've got two smartphones. My kids have iPads and they're 5 and 7. You want to talk about what kids are growing up with these days. And the metaphor for consuming on mobile is an app. And that app is not a web browser. That app is an app controlled predominantly today by Apple. And that's why it's not a good trend in my mind. Facebook, I have taken to calling, instead of the internet, the internet. Or I call it, you know, your mother's AOL. You know, it's a return back to where we were 12 years ago. And even though it's served up in a web browser, they're taking control of everything. It's not an integrated experience. And that's a bad thing for all of us, I believe. And I believe it will ebb and flow. It takes a brave man these days to say that Facebook will peak. But I remember when people were arguing that AOL and Time Warner shouldn't merge because their market power would be so great. Facebook will ebb. Ebb? Ebb or flow? Ebb, right? It'll ebb. I have my thesaurus behind me. And it'll ebb and flow. It'll duck and flow. I'm not down on Facebook. I'm very pro Facebook. The innovation that they've driven is good. They're giving Google a run for the money. And Google was another person's problem, which is they changed the search algorithm